The Federal Reserve just told us that it is going to be a very long time before we come back to those low interest rates. And the markets, they didn't like this news. We're talking all about it in today's video. Hey everyone, and welcome back. I am the part-time economist, and in today's video, we are talking about the most recent press release from the Federal Reserve and the huge differences that many people might have missed compared to the previous press release. So when it comes to the Federal Reserve, when it comes to these press releases, they generally follow a cookie cutter format where they basically say the same thing every month. So it's important to pay attention to very small changes in wording, which is what today's video is all about. Before we get started, I do want to say this is obviously not a financial advice video. I just think it's fascinating how we can see the market reacting to Federal Reserve policy. So with that being said, let's go ahead and jump right in. As you can see from this chart here of the S&P 500 price from yesterday. Now, I'm recording this video the day after. I have no idea what the market's going to be doing today, but as of yesterday, you can see the market going up, excited for this release from the Federal Reserve, and then as soon as that press release comes out, it wasn't what they were looking for, and the market goes back down. So what made the market think this? Well, let's take a look at the March 20th press release and compare it to the May 1st press release. Now, as I said, these typically follow a cookie cutter format. You can see the first sentence on both of these is literally the same. However, start paying attention to the second sentence. In March 20th, the Federal Reserve says inflation has eased over the past year, but remains elevated, right? The idea with this is things are getting better, but it's still not where we would want it. Contrast this with the wording from yesterday. So, as we see here, inflation has eased over the past year, but remains elevated. Same words, literally word for word. But they add this in. In recent months, there has been a lack of further progress towards the committee's 2% inflation objective. That was not in the statement from March 20th. So that's a huge deal because they're specifically telling us, hey, we're not getting to where we want to be. We're not making progress. If we go back to that March 20th statement, we could say, hey, we're on the right path. We're making progress. And I actually made a video around that time frame where I said, look, Bitcoin is an all-time high. The stock market is near an all-time high. People are probably thinking that the Federal Reserve maybe isn't going to lower rates just yet, but that we're getting closer. This here is a much more hawkish approach, in my opinion. It's saying, look, don't even think about these lower interest rates. We're not even going in the right direction anymore. So moving on to the second paragraph, check out what the Federal Reserve said on March 20th. They said, the committee judges that the risks to achieving its employment and inflation goals are moving into better balance, right? So are moving. I'm not sure, but I think that's a present progressive verb. In other words, we are currently in the progress of moving a certain direction, right? However, take a look at the press release from May. Achieving its employment and inflation goals have moved toward better balance over the past year, right? So we're going from that present progressive verb to a past verb. I'm not sure this is actually a simple past tense. I don't know all my grammatical terms, but it's clearly a past tense, right? We have moved over the past year. They're specifically saying, look, we have to look at the past year. Don't just look at the last couple months. We need to look over the entire year to feel that we're making this good progress. So again, they're telling us these last couple months haven't been what we've wanted. Now, check out the third paragraph because this is one of the biggest things of all. It's completely absent in March, so there's nothing to read there. But if we go to May, it says, beginning in June, the committee will slow the pace of decline of its securities holdings by reducing the monthly redemption cap on Treasury securities from 60 billion to 25 billion. So that's pretty big. That's more than a 50% change. And again, I'm not a 100% expert in Treasury and open market operations. It's not my area of expertise within the financial markets. So the way that I look at it, without being an expert, is that in the past, in March, all they were doing is they're saying, look, we are keeping this same federal funds rate. In May, they are saying not only are we keeping the same federal funds rate, but now we're also starting to play with other tools, other levers that we have at our disposal. In this case, their holdings of Treasury bills. So again, that is just my take on the matter. In my personal opinion, when we go back to March, a lot of people, I think, myself included, were saying, okay, we're not necessarily getting lower interest rates right away, but it's something that could be on the near horizon. This May 1st statement, in my opinion, again, not financial advice, but this is saying, look, don't even be thinking about that for a while. If you thought we were on track, we've got to get back on track before we even start thinking about these lower interest rates. Again, that is completely my opinion. If you have a different opinion, something that I missed, something that I didn't consider, of course, I always look forward to reading what you have to say in the comments down below. So, as always, I do appreciate you watching the video. I hope you found it useful, and I'll see you next time.